Today we got a 54, almost 55-year-old and a 53-year-old married couple who wants to retire in roughly 7 years at his age 62. But with all the market volatility recently, they're concerned about what happens if the market declines or corrects right when they retire. Will they still be able to retire, or will they have to cut back spending, or even worse, go back to work? And if you're planning on retiring anytime soon, this is why you need a detailed retirement income plan. Your plan shouldn't just be, I don't know, I'll just figure it out when I get there. And that's what I'm here to help you with. Go to my website, www.pursuitstreetadvisors.com. Grab some time with me. I want to help you build a plan that takes into account not just the good times when we're sipping margaritas on the beach, but let's look at what happens if there's a bear market. Let's look at what happens if I need long-term care, or if you go from 2 Social Security checks down to 1. Because we want a bulletproof retirement plan that factors in all of these scenarios. So first, let's look at the base case on the whiteboard. Then we'll get into some different market scenarios in the software to see if this couple will be able to retire and stay retired no matter what. Like I mentioned, this couple is 54, almost 55 years old, and a 53-year-old. And they both want to retire around his 62nd birthday in about 7 years. And now they're really pushing close into what we call the fragile decade, which is the 5 years before and the 5 years after they retire. And we found that during this time frame, market returns and the sequence of those returns can have a major impact on retirement spending moving forward. So we want to be fairly conservative when projecting their investment returns, even though they're both still contributing to their retirement accounts over this 7-year time frame. They have a combined $325,000 of assets across various accounts. And for this example, we're not really going to focus on the types of accounts they have, just the overall amount. And they both want to claim Social Security at age 65, and their combined benefit's going to be $4,766 per month. And since he works for the federal government, he's got a pension of about $1,500 a month starting at age 62, and their expenses are $48,000 per year. And since we know that the 111-year average for inflation is about 3.26%, that's what we'll estimate for how much their expenses will increase each year. So their $4,000 per month they need now will be $5,310 at retirement age due to inflation. And like I mentioned earlier, since they're going to go into that fragile decade, we want to estimate their stock market returns fairly conservatively. So we're going to say they're going to earn an average rate of return of 6.5% in the market over the next 7 years and into their retirement. Their primary home will also be paid off by next year, and they have a rental property that'll be paid off the year after that. And that nets them about $350 a month after tax and expenses. So on the whiteboard, this looks really good. If everything stays the same with all of these income sources adding up to $6,616 per month and our need of $5,310 at retirement age. And remember, we really want to see at least 3 different sources of income in retirement, whether it be Social Security, pension, rental income, portfolio income, business interests, or anything else, just so we have some different buckets of money we can use. Now, I know you're saying, Will, but what if things don't stay the same? And while we estimate a steady 6.5% rate of return, we know in reality that that's not really how the stock market works. We don't just get a nice even 6.5% per year every year. And that's exactly what these folks are concerned about. What if the market falls by 10% or more right when they retire? Or what if we have multiple years in a row of negative returns or a bear market right when they retire? And that's what I want to look at next, because we need to be prepared for a wide range of outcomes in retirement. All right, so we're looking at our retirement analyzer here, and we want to compare this couple's current scenario on the left here of their 6.5% market returns year over year, which we know probably won't happen, to this more realistic scenario on the right side here with some variable returns thrown in the mix. And this is the first year that they're both retired and will have no working income. And by this point, their investments have grown to $861,427 by making 7 years of additional contributions plus some market returns. But what about a worst case scenario where the market goes down for 4 years in a row as soon as they retire? And the only time the stock market has declined for 4 years in a row was from 1929 to 1933 during the Great Depression. So we'll use that as an example time frame for all you doomsdayers out there. So we have a negative 9.1% market decline in the year they retired. The following year, another minus 11.6% decline, followed by another negative 2.43%, and minus 4.8% in the fourth year post-retirement. And those returns are enough to scare anyone away from retiring during this period. But what if even with this period of poor market performance, they could still retire without fear of running out of money? If you recall, I mentioned a few minutes ago that we need various sources of income in retirement to draw from at different times. Well, this is the reason why. Even with their retirement assets taking an almost $240,000 haircut in the first 4 years, remember, they have their Social Security, pension, and rental income to fall back on during these tough times in the market, so they don't have to take income or sell assets from their portfolio while the market is down, which is a really quick way to prematurely run out of money. And I wish I had a crystal ball, but we have no idea what the stock market might throw at us over the course of our lives, so we need to be prepared for a wide range of outcomes and have enough sources of retirement income to weather any storm. While it's our belief that the markets will continue to go up over time, there will be more volatile segments of that upward trend. So if we scroll all the way down to the end here, we can see that even with 13 down years over a potential 38-year retirement, they still have plenty of assets left, not including their real estate, which could also be sold for additional income if needed. And although they still made it out okay, look at the difference in end value with adding in the variable returns. The point of doing this retirement analysis is to help illustrate to them that regardless of what happens in the stock market, their retirement income plan will hold up because they have more flexibility due to having some guaranteed income sources and some exposed to the market for longer term growth. And this is exactly why you need a detailed retirement income plan to make sure that your retirement investments are set up for when the market corrects. Do I have enough sources of guaranteed income, or do I have to rely entirely on the stock market, which is not always a sure thing over the short term, as we showed above? And that's exactly what we look at with your retirement analysis. And if you want that, click the link in the description below to get in touch with me, and we can talk about all of these important things, okay? I hope this has been helpful and given you a little bit of confidence, but also helped you think about your retirement income needs. Thanks for watching, and if you like this content, make sure to subscribe for more, and we'll see you next time.